Right, so we just also got the latest oil inventory data from the Energy Information Administration in Washington. We're joined by Stephen Schork, principal at the Schork Report. Stephen, just anything jump out for you with these inventory numbers?
Unfortunately, Andy, yes. The two things that jumped out, of course, is the ongoing depletion of the United States Strategic Petroleum Reserve. A year and a half ago, the reserve had more than 53 days of supply or forward cover there. Today, we have fewer than 26 days. So that is the lowest level on a record, essentially. So we've depleted our supplies of emergency oil. And what do we have to show for it? Now, of course, the administration's focused on gasoline prices. Where their eyes off the ball is on heating oil prices. And here in the Northeast, where the majority of the homes use heating oil, prices there are skyrocketing. And this will be probably one of the most expensive heating oil winters that we've ever seen. So the inflation is not abated. To that point, with regard to heating oil, we're looking at supplies of below 12 million barrels a day in New York Harbor in the Mid-Atlantic. This is the delivery point for the heating oil and also the gasoline contract. And both of those inventories are very low. So you can play games as much as you want with the SPR, with crude oil supplies, keeping in mind that you and I, we don't consume crude oil. We consume gasoline, heating oil, diesel fuel, so forth. And the lack of refinery capacity is what is driving the main price spikes higher right now, Andy.
Apparently, the US and Europe are now competing for diesel supplies.
Yes, and that is a situation, again, of the refining capacity and the stronger than expected demand. Typically in New York Harbor, what you would see is if you had, and what we have right now, is the inability to move any more product, diesel fuel, from the Gulf Coast epicenter up along through the Colonial Pipeline that delivers the diesel into the New York Harbor delivery complex. Whenever we've had a strain, U.S. Consumption could be sated by diesel imports coming in from the Amsterdam, Rotterdam, Antwerp, the ARA, Northern European refinery epicenter. So obviously with what we're seeing now, of course, in Europe and the dire situation that they're looking at with regard to this winter, that avenue is not there. And once again, we're looking on both sides of the Atlantic an extreme deficit in diesel fuel and heating oil, which is diesel fuel as well. So once again, it's going to be a very challenging winter for consumers on both sides here.
Just explain, sorry, Stephen, walk us through it again. Why are heating oil and diesel, which are so similar, why are they in such short supply? How do the refiners figure into that?
Yes, absolutely. It is that lack of refinery capacity. Gasoline is where the largest margins are, and gasoline production, even though demand was significantly lower this summer, gasoline production was very stout. But if you have fewer units to be able to maximize your crude oil consumption, that focus is going to be on the higher margin gasoline markets. And what's going to suffer, of course, are the other products that are being produced. Diesel, which the margins are not nearly as great usually as gasoline, has suffered. So you have the combination of strong demand, a lack of refinery capacity, and a focus more on gasoline output than diesel or heating oil output.
Stephen, there's so much to talk to you about. We've heard that Putin in Moscow will not accept price caps on his oil that he sends to places like Europe. I know Europe is winding down its Russian oil purchases. Yes. So what will happen if he is faced with caps? Will he just say, well, OK, I'm just not going to sell you the oil?
Well, certainly he has been in his two avenues of export income has come from China and India. And certainly they haven't shied away, and Russia now has surpassed Saudi Arabia into these economies as the largest exporter. What it will do is certainly the buying. It is a buyer's market right now. So with the cap, already Russian oil has to be sold at a discount, which are benefiting the refiners in India and China. And with a cap, and by the way, as we saw during the Nixon administration, Andrew, price caps never work. But essentially that will give more buying power to China and India, and therefore increase demand for Russian oil.
Where do you see WTI going, Stephen, for the balance of the year, say?
Certainly with what we're concerned about here is the insanity. Of course, the popular saying goes, the definition of insanity is doing the same thing over and over again and expecting different results. We've depleted the SPR of 40% of its supply. And what do we have to show for it? Heating oil prices year over year are up 40%. So where do we go from here, Andrew? Well, we're certainly in a healthy economy where we're at the bottom of the market. That is in that low $80, $85 range. My fear here is that, and my premise here is that the United States is and has been in recession. Now, with what we're going to see out of the Fed, the fear is that we're going to see a hard landing, economic landing, which will lead to, of course, a severe recession. If that is indeed the case over the next 12 months, Andrew, we're looking at crude oil prices back below $50 a barrel.
Oof. We actually just inadvertently put up a company with the ticker symbol WTI. It's called WT Offshore. Maybe we'll put up a 5-year chart for oil itself. That's interesting. So oil, $50, that will match what Mike McGlone, a frequent guest on commodities, has been saying. He's a Bloomberg intelligence analyst. He says that oil has got this gravitational pull towards $50 US.
Yeah, absolutely. And what is that going to do? It's U.S. crude oil production has yet to rebound to where we were prior to COVID. And that was in an $80 to $100 barrel environment. Now we drive prices down. Of course, what does this mean? It means, why are we going lower? We never want to see low commodity prices because this is clear sign of economic contraction. So we'll see those prices, because if we do see that hard landing, of course, we're going to see a tremendous amount of demand decay. And what does this do going forward? It's certainly going to retard investments going into getting more oil on the ground. So we're looking at a low supply, low production scenario over the next, at least through 2023 and into 2024.
Stephen, it's always